There is a moment, and financial historians can point to it almost to the hour, when the 2008 financial crisis stopped being a mortgage problem and became a global catastrophe. It wasn't when Lehman Brothers filed for bankruptcy. It was the morning after, when banks looked at each other across the interbank lending market and said, "I don't trust you enough to lend you money overnight." That moment, when banks stop trusting each other, when the overnight lending market freezes, is what turns a bad situation into a catastrophic one. And in 2026, the conditions that could trigger that freeze are more present than most people are willing to admit. What happens to your savings account, your mortgage, your investments, your job, when the plumbing of the entire global financial system seizes up? That's what we're talking about today, and you need to understand this. Let me start with something that I think most people genuinely don't know, and it's not because they're not smart, it's because nobody ever explains this part. Banks don't just hold your money and lend it out to people buying houses. That's a wildly oversimplified version of what banks actually do. The reality of how banks operate is far more interconnected, far more interdependent, and honestly, far more fragile than the version you learned in school. Here's the thing about banks. They run on short-term funding to support long-term lending. Think about what that means in practice. A bank might lend someone a 30-year mortgage, money locked up for 3 decades, but the deposits funding that mortgage can be withdrawn by customers tomorrow. So banks are constantly managing a mismatch between short-term liabilities and long-term assets. To bridge that gap, they borrow from each other every single night. This overnight lending market, called the federal funds market in the US and various equivalents globally, is enormous. We're talking trillions of dollars changing hands between financial institutions literally every night. Banks with surplus reserves lend to banks that need cash to meet their reserve requirements. The interest rate on these overnight loans, the federal funds rate, is literally the most important interest rate in the world because it sets the floor for virtually every other rate in the financial system. Your mortgage rate, your car loan rate, your credit card rate, the yield on your savings account, all of it traces back to what banks are charging each other for overnight money. Beyond overnight lending, there's the broader interbank market, where banks lend to each other for periods ranging from 1 day to 1 year. The benchmark rate was historically called LIBOR, the London Interbank Offered Rate, which was the rate at which major banks reported they could borrow from each other. LIBOR was phased out after a manipulation scandal in the 2010s and replaced with newer benchmarks like SOFR, the Secured Overnight Financing Rate in the United States. But the fundamental mechanism remains the same. Banks need to trust each other to lend to each other, and the rate they charge each other reflects that trust level. When trust evaporates, the rate spikes, and when the rate spikes dramatically, or when lending stops altogether, the entire financial system begins to malfunction. Here's an analogy that I think captures this perfectly. Imagine the interbank lending market is like the blood circulatory system in your body. When blood flows freely, every organ gets what it needs: oxygen, nutrients, everything it needs to function. You feel fine, you don't even think about it. But when blood flow is restricted, when there's a blockage, the organs downstream start failing. First slowly, then catastrophically. And the terrifying thing about circulatory failure is how fast it can go from manageable to fatal. That is exactly what happens to the economy when interbank lending freezes, and we don't have to speculate about what that looks like, because we've lived through it. Let me show you. September 15, 2008, Lehman Brothers files for Chapter 11 bankruptcy. 158 years of history, gone overnight, and within 24 hours, something extraordinary and terrifying happened in the interbank market. Banks simply stopped lending to each other. Here's the mechanism. Every bank on earth knew that Lehman had counterparty exposure to dozens of other banks, meaning Lehman had lent money to or entered into financial contracts with banks all around the world. The problem was that nobody knew exactly which banks were most exposed. Nobody had full visibility into the web of connections. So the rational response, from the perspective of any individual bank's risk management team, was to stop lending to everyone until the picture became clearer. Better to hoard your cash than to lend it to a counterparty that might be the next Lehman.
The result was the TED spread, the difference between the rate banks charge each other and the rate on safe US Treasury bills, exploding to levels that had never been seen before. In normal times, that spread sits around 10 to 50 basis points, tiny, almost irrelevant. In October 2008, it hit 465 basis points. 465! That is the financial equivalent of a patient's heart rate going from 70 beats per minute to 450. It is a system in cardiac arrest. What happened next? The money market funds, which are the cash equivalent investments where companies, municipalities, and millions of individual investors park their cash, started breaking. The Reserve Primary Fund, one of the oldest money market funds in America, broke the buck on September 16, 2008. That means its net asset value fell below $1 per share, an event so rare and so alarming that it triggered a run on money market funds globally. Within days, approximately $300 billion had been pulled out of prime money market funds. $300 billion in days. Companies that relied on commercial paper, short-term corporate IOUs that they sell to money market funds to fund payroll, inventory, daily operations, suddenly couldn't roll their paper. Perfectly solvent, profitable companies couldn't fund their basic operations. General Electric, at the time one of the largest and most profitable corporations in the world, found itself unable to access short-term funding markets normally. The Federal Reserve had to create a special facility, the Commercial Paper Funding Facility, specifically to prevent major American corporations from running out of operating cash. Now let me show you something that might be the most important statistic in this entire video. In the 4 weeks following Lehman's collapse, US GDP was running at an annualized decline rate of approximately 8.9%, nearly 9% contraction. In a single quarter, the US economy lost the equivalent of what it would normally grow in multiple years. The unemployment rate went from 6.1% in September 2008 to 10% by October 2009. 8.7 million jobs gone, all because banks stopped trusting each other for a few critical weeks. And here's the question I need you to sit with right now. Do you think the conditions that could produce a similar loss of trust between financial institutions have been permanently eliminated? Or do you think they've simply been managed, papered over, regulated around, while the underlying vulnerabilities evolved into new forms? Because I think you know the answer. Let me show you what those new forms look like in 2026. After 2008, the world's financial regulators got to work. Dodd-Frank in the United States, Basel III internationally, stress tests, liquidity coverage ratios, capital requirements that banks actually have to meet. And these reforms genuinely made the banking system more resilient in important ways. The largest US and European banks are better capitalized today than they were in 2007. That is a real improvement, and it matters. But here's what the reforms didn't do. They didn't eliminate the fundamental fragility of a system built on trust and short-term funding. They raised the bar for how much capital banks need to hold. They didn't change the basic architecture. And in 2026, that architecture is facing stress from several directions that the post-2008 reformers didn't fully anticipate. Start with the regional banking sector. March 2023 was a wake-up call that a lot of people have already half forgotten. Silicon Valley Bank, the 16th largest bank in the United States, collapsed in approximately 48 hours. Not because of bad loans exactly, because of a classic duration mismatch amplified by the fastest interest rate hike cycle in 40 years. SVB had loaded up on long-duration treasury bonds and mortgage-backed securities when rates were near zero. When the Fed hiked rates aggressively in 2022 and 2023, the market value of those bonds fell sharply. SVB was sitting on massive unrealized losses. When word got out, accelerated by social media and messaging apps moving information faster than any previous bank run in history, depositors pulled $42 billion in a single day. One day. The FDIC had to step in the next morning. Within days, Signature Bank was gone. First Republic Bank followed in May 2023, taken over by JP Morgan in the largest U.S. bank failure since Washington Mutual in 2008. And across the Atlantic, Credit Suisse, a 167-year-old institution, a global systemically important bank, had to be emergency rescued by UBS in a deal engineered over a single weekend by Swiss regulators who were terrified of what an uncontrolled Credit Suisse collapse would do to global interbank markets. Now, in 2026, the regional banking sector is still navigating two lingering stress factors from that period. First, commercial real estate. Approximately $2.7 trillion in commercial real estate loans are held by U.S. banks, with regional and community banks carrying a disproportionate share of that exposure. Office vacancy rates in major U.S. cities remain elevated as hybrid work patterns have permanently reduced demand for office space. When commercial real estate loans go bad, the losses hit bank balance sheets directly, and bank balance sheet losses, as we saw in 2008, as we saw with SVB, erode confidence. Eroded confidence leads to tighter interbank lending. Tighter interbank lending leads to reduced credit availability for everyone. Second, the shadow banking system, or what regulators now prefer to call non-bank financial intermediaries. Hedge funds, private credit funds, money market funds, insurance companies, these entities now hold a larger share of global financial assets than the traditional banking sector. According to the Financial Stability Board's 2025 report, non-bank financial institutions account for nearly 50% of global financial assets, approximately $218 trillion. These entities are less regulated than banks, hold less capital as a buffer, and their connections to the traditional banking system are complex and not always fully transparent. In a stress event, the failure of a major hedge fund or private credit vehicle could trigger the same kind of who else is exposed panic that froze the interbank market in 2008. We got a preview of this in March 2020 when the pandemic triggered a dash for cash. Treasury markets, which are supposed to be the most liquid markets in the world, momentarily seized up as hedge funds and leveraged investors simultaneously tried to sell everything. spiraling. The Fed had to intervene. The shape of the risk has changed since 2008. The scale has grown, and the speed at which information and panic travels has increased by an order of magnitude. Social media-driven bank runs, as SVB demonstrated, can happen in hours, not weeks. That compression of crisis timelines is one of the most important and underappreciated features of the 2026 financial landscape. So what does a modern interbank freeze actually look like for you? Not as a macroeconomic statistic, but as a real person with a bank account, a mortgage, investments, and a job. And more importantly, what do you do about it? Let's go.
Let me stop talking about this in abstract financial terms for a minute, because I think it's important that you feel the concrete reality of what an interbank lending freeze actually does to everyday life. Because this is not just about banks, this is about you. Think about how money actually reaches you. Your employer doesn't keep 6 months of payroll in a vault. They finance operations using credit lines, short-term borrowing from banks that they roll over continuously. When interbank lending tightens dramatically, banks pull back on business credit lines. When businesses lose access to short-term credit, the first thing many of them do, because they have to, is cut costs. The fastest cost to cut is people. That's how an interbank freeze becomes your pink slip, not in some abstract macroeconomic sense, directly, causally. Your mortgage. If you're looking to buy a home, refinance, or access a home equity line of credit, all of that dries up when banks are hoarding liquidity. Lending standards tighten overnight, rates spike, or loans simply become unavailable regardless of your creditworthiness. During the worst of 2008, mortgage originations collapsed. The housing market, already stressed, accelerated into free fall partly because credit simply wasn't available at any reasonable price for most buyers. Your savings. In a genuine credit freeze, the immediate concern is deposit safety. Here's what you need to know about FDIC insurance right now. In 2026, the FDIC insures deposits up to $250,000 per depositor, per bank, per account category. That limit has held since the financial crisis. If you have more than $250,000 at a single institution, and many small business owners, retirees, and working professionals do, the amount above that limit is at risk in a bank failure. The FDIC has always managed to protect even uninsured depositors during recent failures, but that is not a legal guarantee. It's a policy choice, and it has limits depending on the size and number of simultaneous failures. Your investments. In a genuine credit freeze, markets sell off hard and fast, and the sell-off is not rational or surgical. It's not like the stocks of genuinely bad companies go down while solid companies hold up. When liquidity becomes the priority, when funds need cash, when margin calls hit leveraged investors, when redemptions spike, everything gets sold. Good stocks, bad stocks, gold, bonds, everything converts to cash because cash is the only thing that has guaranteed value in a trust crisis. We saw this pattern in March 2020. Even treasury bonds, the traditional safe haven, sold off simultaneously as everyone scrambled for dollar liquidity. Your 401k balance does not distinguish between rational and irrational selling. And here's the broader economic consequence. Credit is not an optional feature of a modern economy. It is the oxygen. Small businesses use credit to manage cash flow between invoices. Farmers use credit to plant their crops before they can sell them. Manufacturers use credit to buy components before they can sell their finished product. Home builders use credit to build houses before they can sell them. When credit freezes, when banks stop lending to each other and then stop lending to businesses and individuals, the economy doesn't slow down gradually, it hits a wall. That's the nightmare scenario. But here's the thing. Understanding it is the first step to protecting yourself from it. Let me give you the exact playbook. All right, here is what I want you to actually do. Not what to think about doing, not what to consider at some point, what to do. Because if any of what I've described tonight has landed for you, if you understand even a little bit more about how fragile the financial plumbing beneath your feet actually is, then the right response is not anxiety. The right response is preparation. Let me walk you through 6 specific actions. These are practical, they're realistic, and together they build a meaningful buffer between you and the consequences of an interbank stress event. 1. Know your FDIC coverage situation right now. Go look at how much you have at each bank. If any single account at any single institution holds more than $250,000, you need to restructure that immediately, either by spreading it across multiple banks, using different account ownership categories, or moving excess above the limit into treasury bills or money market funds backed exclusively by government securities. This is not paranoia. This is basic financial hygiene that millions of people neglect until it's too late.
SVB's uninsured depositors, many of them tech startups and small businesses, came within hours of losing everything above $250,000 before the FDIC made the extraordinary decision to guarantee them. Don't bet your financial life on that decision being made the same way in the next crisis. 2. Understand the difference between money market funds. Not all money market funds are equal in a stress event. Government money market funds, which hold only U.S. Treasury securities and other government-backed paper, are significantly safer in a credit freeze than prime money market funds, which hold commercial paper and other short-term corporate debt. In 2008, prime money market funds are what broke. Government money market funds held up. In 2026, if you're parking cash in a money market fund, which you probably should be to earn meaningful yield on your cash, make sure you know which type you own. If it's prime, consider whether a government fund is more appropriate for at least a portion of that cash. 3. Diversify your banking relationships deliberately. I know it sounds convenient to have everything at one institution, one app, one login, one place, but concentration at a single bank is a real risk. Consider having accounts at 2 or 3 different institutions, including at least one large systemically important bank and potentially a credit union or smaller regional bank with strong capitalization metrics. FDIC coverage at multiple institutions means effective coverage multiplies, and if one institution has a problem, you have immediate access to funds elsewhere. In a fast-moving bank stress situation, "I'll sort this out later" becomes "I can't access any money right now" very quickly. 4. Keep a physical cash reserve. I know this sounds almost quaint in 2026. Everything is digital, everything is tap to pay, but in a genuine financial stress event, think SVB, where ATM access was temporarily uncertain for some customers in the hours of confusion before the FDIC announcement, having physical cash on hand is not crazy, it's prudent. I'm not saying stack gold bars in your basement, I'm saying have enough cash outside of the banking system to handle 1 to 2 weeks of essential expenses, groceries, gas, immediate needs. It's cheap insurance. 5. For your investment portfolio, understand your liquidity ladder. In a credit freeze and market sell-off, the worst thing you can do is be forced to sell assets at distressed prices because you need cash immediately. This is where the conventional wisdom about emergency funds is actually financial wisdom, not just budgeting advice. 3 to 6 months of living expenses in liquid, safe instruments means that a market downturn does not force you to liquidate your long-term investments at the worst possible time. Your emergency fund is not just a rainy day fund, it is your defense mechanism against forced selling in a crisis. 6. If you're an investor, pay attention to financial sector stocks in your portfolio and the broader credit market indicators that professional investors watch. 2 specific metrics: the TED spread, which we discussed earlier, the gap between interbank rates and treasury rates, and high-yield credit spreads, which measure how much extra interest risky borrowers have to pay over safe government bonds. When these spreads widen sharply, it means stress is building in credit markets. You don't need to check these daily, but bookmarking them and checking monthly gives you meaningful early warning that the financial system's stress level is rising, well before it shows up dramatically in stock prices. And let me give you the mindset framework that ties all of this together, because tactics without a mindset are useless when things get chaotic. In a genuine financial stress event, panic is the enemy of good decision-making. The people who protected and grew their wealth through 2008, through March 2020, through the SVB panic, they were not the people who predicted the crisis perfectly. They were the people who were already positioned defensively and who had enough psychological preparedness not to make terrible decisions under pressure. Information leads to preparation. Preparation leads to calm. Calm leads to good decisions. You are building that preparedness right now. Let's finish strong. Here's the bottom line. The global financial system runs on trust, not money. Trust. Banks lending to each other every night because they believe the other bank will be there in the morning. When that trust frays, when the overnight lending market seizes up, when the TED spread goes vertical, when money market funds break the buck, what follows is not a tidy recession that economists study from a distance. It is a real-world catastrophe that costs people their jobs, their savings, their homes, and in some cases, their life's work. We have seen this happen. In 2008, the world got a very close look at what financial system cardiac arrest looks like. In March 2020, we got a reminder that even in a reformed, better capitalized system, the plumbing can still crack under enough pressure.
And in 2026, between regional bank stress, commercial real estate exposure, the explosive growth of the shadow banking sector, and a geopolitical environment that creates new and unpredictable financial shocks, the conditions for another stress event are more present than most commentators want to acknowledge. That doesn't mean a crisis is certain, it means it's possible. And the difference between possible and catastrophic is almost entirely determined by how prepared you are before it happens, not how fast you react after. I want to know where you are on this. Drop a comment below. Have you ever thought about your FDIC coverage limits before today? Do you know whether your money market fund is government or prime? These are simple questions that most people can't answer, and I want to hear from you. If this video helped you see something you couldn't see before, if it gave you one thing you're going to actually do differently with your money, hit that like button. That one click genuinely helps this content reach more people who need this information. And subscribe if you're serious about understanding the financial system at a level that actually protects you, because this channel exists for exactly that purpose. Coming up, we are going deep on what the Federal Reserve actually does when a credit crisis hits, and why the tools they used in 2008 and 2020 may not work the same way in the next crisis. That one is going to fundamentally change how you think about central bank power. Don't miss it. I'll see you there.
Subscribe to Investify. More financial videos, real insights, zero fluff. Let's build wealth together.